Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending May 13th, 2022. I'm President Brent. Thanks for tuning in. This week's theme is, are the Feds really in control? Well, we're going to find out here over the next 90 days or so. But first, let's just kind of go through where the markets have been. We'll take a look at the charts and I'll kind of give you an idea where we could possibly go from here. So why don't we start off with the index performance for this past week? As you can see, all the major indexes recorded another week of losses. Most investors are really skeptical, as I said, of the Fed, and are they going to be able to achieve a soft landing for the economy or not by raising the rates enough to tame inflation without causing a recession? It's kind of I did give it about a 25% chance of running into a recession. I bumped it up to about 35% or so. I'm still below 50-50 because the underlying strength in the market, especially the earnings, are still very strong. But as you can see up here, everybody for the week, even with the strong finish on Friday, we're down more than a couple of percent across all indexes. You can see everybody's in correction territory. NASDAQ and Russell are in bear market territory. Now, that's just the downside for the year to date. From the all-time highs, we're in deeper bear market territory for NASDAQ and the Russell than what's shown there. S&P and Dow both in correction territory. Keep in mind that this is the sixth consecutive week of declines for both the S&P and Nasdaq, okay? And the seventh for the Dow. It's the longest stretch since 2001. So we've not had a very good start to this year, clearly. Right? There's plenty to worry about in the market. So as I said, we've got the accelerated pace of monetary tightening as the Feds are going to be looking to start the balance sheet reduction in June, raising interest rates, persistently high inflation, worries about slowing growth, disruptions caused by this strict China COVID lockdown policy that they're doing over there, Russia's invasion of Ukraine. So there's plenty of wall to worry here that the markets, can go up or down. Any one of these can cause some major problems in the market. You can see here the best performing sector for the week, staples, which is traditionally a risk off kind of performance sector, barely finished in the green. Just about everybody else was in the red. Real estate was the worst, down 388. You can see year to date, energy is obviously the strongest, just under 50% return. Discretionary is the worst at 25.38. You can see the PE ratio for the S&P, the forward 12 months coming in at 17.45. So it was up over 21. It's dropped dramatically. So this revaluation, this orderly move lower, and I call it orderly, has slowly taken a lot of valuation out of the markets. Okay, a lot. The S&P dividend yield finished out the week at 1.53. 10-year Treasury pulled back below 3% to finish at 2.94. So the Treasury yield is a little bit higher than the dividend yield, but you can see the earnings yield for the S&P is coming in at a robust little over 5%. And then when we apply the inflation to that number, we're underwater about 3.19%. So the real yield is still negative at this point in time. And of course, the VIX, given the year-to-date or the weekly move lower, but with that strong finish on Friday, it did lessen some of the impact of the VIX moving higher. We finished the week at 28.87. So it was up about 6.2% for the week. But still, all in all, an ugly week. Okay, now everybody's wondering if the momentum from Friday's move can continue into Monday. I do believe we're going to have a little bit of a continued momentum push higher, but it's going to be short-lived. If we look at some of the economic data that came out for the week, the CPI fell back just a bit in March. It rose 8.3% year over year versus a consensus estimate of 8.1. So higher than people thought, but less than the 8.5% from the prior month. Core consumer inflation, which excludes food and energy, pulled back less than expected to 6.2%. PPI rose also in April as well. So inflation is still staying very hot. And then on Friday, we get the release of the consumer sentiment, which is showing a steep toll that inflation has taken on the American confidence in the markets. It fell to 59.1. The estimate was 64. That's the lowest level consumer sentiment has had in 13 years. Okay. Um, and a lot of the survey respondents in this consumer sentiment survey reported the worst conditions for buying appliances and other durable goods since researchers began asking that question in 1978. So, all in all, not very good from an economic data perspective. Okay. And of course, US Treasuries, as I indicated, fell back below that proverbial 3% line, coming in for the week at 2.94%. If we go over to Europe, take a look at Europe, the ECB president there, Christine Queen Bee Lagarde, I like to call her, said their bond buying program is going to end in early third quarter, followed by rate increases only a few weeks later. So they pushed out their first rate hike till Q3. Meanwhile, the UK GDP unexpectedly contracted 10 basis points in March after stagnating in February. Okay. Due mainly to a decline in their service sector activity. The economy grew 80 basis points in Q1, but this was below the 1% expected growth. Okay. And by the way, their Q4 expansion last year was 1.3%. So everything is slowing down there across Europe. And then one final note here. We're going to see this Sunday. Finland is expected to formally announce its decision to join NATO this Sunday, along with Sweden. That could cause more friction, of course, with Russia, but let's see how all of that stuff shapes itself out. Okay. Now, index wise, you can see across Europe, everything was in the green for the week, unlike the US markets. You can see the Euro stocks, FTSE, CAC 40, DAX, all of them in the green. Year to date, the only one in the green is the FTSE. It's barely in the green. Everybody else is either in correction territory or close to it. Okay. And then, of course, if we go over and look at the Asian markets, Japan is one of the few central banks that's still committed to monetary stimulus. Same thing with China. Okay, both of them are committed to monetary stimulus, unlike the ECB and the Feds here in the U.S. They're committed to this. China, their stocks rallied because there was a fall in the COVID cases. Hopefully, they'll shut down their ludicrous zero COVID policy. And then on an inflation front in China, just like the U.S., it's higher than expected, over 8%. So, all in all, not very good for the markets right now, although I think it's kind of setting itself up for a nice little bounce here. What I want to do is shift the screen, and I am going to show you an interesting chart here of the SPX, the cash index. It's on a weekly chart, and I've got a couple of indicators overlaid on this index. The first one I got, which a lot of people don't use that often, is the Andrews pitchfork. Now, I like using that when I'm going weekly or monthly charts and I'm going out over time. I'm projecting over the next 12 months. And you can see here, I picked key pivot points. The first one was in the December low in 2018. Then I picked the pre-pandemic high and the pandemic low. And that creates an Andrews pitchfork rendering with this blue line, which is the mean movement. And you can see it's a bullish movement left to right up on the screen here of the SPX. But you can see just how far price action got above the mean. And then if you look at the upper boundary of the Andrews pitchfork, that orange line there, you can see just how extended the SPX became. A lot of this was due to the extra $4 trillion that has been thrown into the market. Now, in addition to this Andrews pitchfork, I've also put in two Fibonacci sequences. One, a retracement from the highs here using the pivot low and the pivot high, and another, an extension, a fib extension off the pre-pandemic high and the pandemic low. So when we really zoom in on this, you can see here very closely where we're sitting. I've told our members that I was expecting near term a move down to around the 3,800 level, okay? Possibly taking us down to 3,700, 3,600, 3,700 area right here. And these dark, heavier, thicker, bolder lines are the Fibonacci extensions off the previous pandemic high. The smaller lines, or the retracements off of the all-time highs of the markets, and you can see where there's areas of congruency. This means this is where market price action tends to bunch up in pairs, right? So we've got one area of congruency here that runs from 4160 to 4200, okay? This would be a common strong resistance point right here. There's another area of congruency right here, which is more of a support area from 3874 down to, let's call it 3800, okay? So we're in this area of congruency right here. And this is where I think we're going to stay for a little bit. We're going to chop in this area where we may move up to the northern boundary here or down to the southern boundary. We will eventually break. When we break and where we break is going to be an interesting tell. What I'm seeing in the charts is that we're now, you can see that weekly candle there is a hammer, which suggests more bullish action to come, which would take us up to this 4,200 level up here. That's going to be the moment of truth for the markets. You can see right here. Now, this is a weekly chart, guys. So all of these bars represent over 2.5 months of time, okay, from April to July, that we just, and that is a common extension off of that prior pre-pandemic high, 1.61 extension. That is a very common extension of previous high points for Fibonacci when there's heavy profit taking. Now you can see we sat there, like I said, for several months. And then all of this extra stimulus money spending just really accelerated the markets up. And then it pretty much took it all away, which does not surprise me at all. So I do believe we got some momentum running back up to that 4,200 level, at which point I think we're going to run into trouble and we're going to roll back over and possibly make new lows down in this area here. Okay. Now, another common extension off a prior pivot high is right here at 1.23, which takes us down to about 3,700. Okay. So there is a wide range here, wide primarily because we got a lot of volatility in the market, but a lot of movement that we can see here in this market. Near-term momentum up. I do believe we're going to experience June, July. We're going to come back down again, possibly make new lows, and then we're going to see where the markets want to go from here, okay? If I switch over and give you a another day view of the S&P, you can see right here that we did on Thursday hit lows that put us down 19.82%, almost a bear market on May 12th. Okay, we came down to 38.55. Now I was saying around 3,800. And remember this, we're looking at the futures now instead of the SPX cash index. The futures shows a 38% retracement, just slightly below 3,800. So I call that 3,800 area. We almost hit it, okay? You can see this regression channel. You can see the 50 EMA, the 200 EMA. It's a bear market looking chart. And traditionally, when you get a chart like this, there is usually some strong upside movement, but then it peters out and we roll back over again. So I would not be surprised to see that also happen. If we look at the Dow, which is from a percentage standpoint, the strongest market holdup, you can see we also on May 12th was down 15.43%. You can see the 50 and the 200 splayed out there. I don't think we're going to roll back up over the 50 EMA anytime soon. We could run up towards it, but I think if we get up in this area up here, we're going to roll back over again. Now let's look at Nasdaq. Nasdaq was the one that had a strong day on Friday. They were up 416 points. But look at where we were on May 12th. Okay, we were down over 30%. That's serious bear market for Nasdaq. Okay, very hard down. And now we actually hit, my target was around the 12,400, 12,500 area. We came all the way down to 11.6, right? 11.7. This is going to serve as resistance. You can see the 50 and the 200 well north of us. Like the other indexes, the 50 is below the 200. So any movement up in this area is probably going to be met by sellers, and it's going to roll back over again. No divergences in the MACD. This does suggest that we've got some upside momentum, but it's going to run out of energy here pretty soon. Okay, that's the NASDAQ. And then, of course, if we look at the Russell, also had a strong day on Friday. But you can see here, again, on May 12th, if I just kind of zoom in a little bit here, you can see we were down almost 31%. Okay, that was my target right there. We closed at my target for the rut, but still a lot of damage done in that market. A ton of damage. The 50 and the 200 well down, bear market territory. Typically a bear market chart, you run up to the 50 EMA, and then sometimes you move over it, but then you get pushed back at the 200, or most of the time you're going to get pushed back at the 50 EMA, like you can see here. Here we did broach the 50, but we could not quite make it up to the 200, and we roll back over again, right? So that's a little bit about what I'm seeing here on these markets. Now, if we come down here and look at volatility and we look at the VIX, it did close down on Friday by 2.9 points, but we're still in the upper boundary here. Once VIX gets over 30 into this red zone here, we've got a lot of crazy fast action in the markets. But I do believe the momentum is gonna carry us down a little bit, but by the way, since we hit the COVID crisis, the VIX has not been in the green zone since the COVID crisis. Okay. We've come into the high teens, but we've never been able to get back into the green again. It's going to take some time for us to get there. All right. That's a little bit about what I'm seeing. And of course, if we look at treasuries, we look at the bond market, it was down hard on Friday, but it's coming up off these lows right here. Interest rates. Now, we've traded bonds and interest rates perfectly. Our members have made a ton of money with this. I was calling shorting bonds back in Q4 of last year. It's been a great trade. You can see here, we're well into the red on the bond market. You can see the 2021 close. We're at near the 2022 lows right now. I think it can go even lower. Any rally in the bond market is going to be sold off. Okay. I do believe at the end of the year, interest rates will be a little bit lower than where they are now. But for the time being, we're going to be consolidating down here at this level. This is not a place to be going short bonds. That was back over here when I was calling it out for you guys. Okay. Of course, if we look at currencies, the dollar came down on Friday, but and I haven't even marked it up on my chart here. Let me mark it up here. But the dollar was all the way up here to 105, just huge, the dollar index. Okay. This is because over in Europe, the euro is cratering because of the problems with Europe and the Eastern Front with Russia and Ukraine, the energy crisis, the high inflation. And Christine Queen Bee Lagarde, as I said, is not due to raise rates there till Q3, Q4 of this year. So they're way behind. Their economy is a lot more fragile than the U.S. economy right now. So this does show with the MACD that any drawdown here in the dollar is probably going to be bought and it's going to move back up. Of course, if we look at the euro, longer term, I like being long the euro, but you can see here, let me just get it down. There's a lot of bets that the euro is going to go to parity. You can see it was down to 103.6, very close to parity with the U.S. dollar. You can see my various bear targets here have kept getting broached. Each bear target is turned out to be a resistance zone when the euro moves higher. Okay. So I do believe the euro could have a little bit of a bounce with momentum this next week, but it's going to roll back over again. Okay. The yen is just in really sad shape. Any bounce here is going to roll over. Keep in mind the yen, the reason why it is so underperforming is because the central bank of Japan is still putting stimulus into the economy there. They finally got inflation up to about 1.8, 1.9%. They're trying to get that 2%, but they've been trying to get 2% inflation for decades. Maybe they will get it. But it's a manipulated market in Japan because about 85% of all ETFs, Japanese ETFs, are owned by the Japanese government, right? They own about 70 or 80% of all bonds also. So it's a manipulated move. But this is a huge sell-off in the yen. Just ugly, ugly, ugly. And of course, if we come down and look at metals, gold, well, as I said, gold is now catching up to silver. We've moved down near the 2022 low price. We were up here with gold, and we've totally given it up. Okay, totally given it up. And if we look at silver, silver moved up a little bit on Friday, but you can see we've made new 2022 low prices in silver as well. All right, on Friday. Ugly, ugly, ugly. So it's just not that good for precious metals at this point in time. Not good at all. And of course, if we come down here and look at oil, oil had a strong day on Friday, finishing up over $4. Oil is staying bid because they've got Europe is trying to extricate themselves from Russian oil, and that's going to put a bid in oil for the near term, probably back up to the 115, 116 area. Okay. Again, our members are trading oil the best way that we know how. We got a great way to trade it, and we're making money in the oil market for traders that are following our process in oil futures. The same thing can also be said for gold as well. We've got some nice trades in gold that are working out nicely. And of course, if we look at nat gas, even though it came down on Friday, okay, you can see here that nat gas is going to stay bid because Europe, again, is trying to wean themselves from Russian nat gas, just as they are with oil. So that's kind of where we're sitting right now, guys, on the markets. Members, we're going to spend a little bit more time on some key trades, key opportunities, and just kind of where the market's going to go, and just looking at the bond market and the interest rates. We'll kind of cover that too. If you're not in our membership group, I highly encourage you to come in. We're in the green this year. We're doing well. I think the rest of this year is going to be very interesting with some surprises for everybody. But the way we trade the markets, it makes it easy to follow. And we're not necessarily directional based. Okay. But we're not really running iron condors per se, because those can be very dangerous with volatility bouncing around like it is. All right, everybody, that's kind of where we're sitting right now. Everybody have a great weekend. Members, I will see you this Sunday evening for our weekly market watch. Take care, everybody. Ciao now.